Your life savings are not sitting in a vault waiting for you. They are essentially non existent digits flickering on a server. When you swipe your debit card, the bank isn't pulling your physical cash from a drawer. It is initiating a complex ledger dance that creates money out of thin air. This is how the modern banking system actually functions and why your balance is just a promise. Will share? It reveals the hidden engine of modern wealth that most people walk right past every single day without noticing. So sit back, grab a cup of coffee, and let us break down the architecture of the modern economy. Imagine you walk into a neighborhood bank branch to deposit $1,000 in cash. You see the teller count the crisp green notes, slide them into a counting machine, and click a button. To you, that $1,000 is now sitting safely in your checking account, ready to be spent on groceries or rent. But for the bank, that cash is a liability. Because they owe it back to you upon demand, they cannot just leave it sitting in a vault where it earns exactly 0% interest. That is where the first mechanism of the banking system kicks in, the concept of fractional reserve banking. In the United States, regulations have historically required banks to hold only a tiny fraction of their deposits as liquid reserves. If you deposit $1,000, the bank might only be required to keep 10% in the vault. That means they're free to lend out the remaining $900 to someone else, perhaps a local entrepreneur looking to buy a new espresso machine for their startup. Now, here is the magic trick of the system. That borrower takes the $900 and spends it. The shop owner who receives that money then deposits it into their own bank. Suddenly, that second bank has $810 available to lend out after keeping their reserve. Do you see what is happening? Money is being multiplied through the act of lending. The original $1,000 you deposited has now technically become $1,900 in circulation, simply because banks are acting as the bridge between savers and borrowers. It is not physical cash being printed in a basement. It is the expansion of credit that keeps the wheels of commerce turning. If you are finding this helpful, hit subscribe. I drop deep dives like this every single week. It helps the channel grow and ensures you stay ahead of the curve as we unpack more complex systems. Now, let us look at the second major pillar of this machine, the central bank, specifically the FAD. Think of the Federal Reserve not just as a regulatory body, but as the bank for banks. When a commercial bank runs low on cash reserves, they do not just go to a local ATM. They borrow money from the Federal Reserve or from other banks via the federal funds market. The interest rate on these short-term loans is the single most important number in the global economy. When the Federal Reserve raises that rate, it becomes more expensive for banks to borrow money. Consequently, they pass that cost on to you in the form of higher rates on mortgages, car loans, and credit card debt. This is the lever they pull to slow down or speed up the entire national economy. If inflation is heating up and prices are rising too fast, they hike rates to discourage borrowing and cool down the spending spree. It is a delicate balancing act that requires constant monitoring of unemployment statistics, consumer price indexes, and global supply chain data. It can feel frustrating when your interest rates go up, but without this mechanism, the economy could theoretically spiral into runaway hyperinflation where your money loses value by the hour. So, we have the creation of money through credit and the regulation of money through interest rates. But wait, there is something even more foundational that most people overlook. Okay, remember how I said the best one was coming? Here is the final piece of the puzzle, the clearinghouse system and the shift from trust to verification. You might imagine that when you send money to a friend via a banking app, the physical coins are being trucked across the state, not even close. Banks use a massive, interconnected network called the ACH or Automated Clearinghouse. When you hit send on a payment, you are essentially creating a message that travels through a digital labyrinth. Banks settle their differences at the end of the day by comparing these messages and transferring only the net amounts between themselves. It is an accounting miracle of epic proportions. This is why transfers can take a few business days. The banks are literally auditing their collective ledger to ensure that for every dollar added to one person's account, a corresponding decrease happens somewhere else in the network. Think about the scale. Every single day, tens of trillions of dollars move through systems like SWIFT and CHIPS. It is the backbone of global capitalism. If this system were to blink for even a few hours, the global supply of food, energy, and medicine would grind to a halt because no one would be able to pay for anything. It is not just about numbers on a screen. It is about the implicit, ironclad trust that millions of institutions have in one another's ability to settle accounts. That, my friend, is how the world stays in motion. It is a system built on reputation, regulation, and the relentless speed of digital ledgers. So there you have it. The three gears of the banking machine: credit expansion, interest rate regulation, and the silent, massive engine of the clearinghouse system. Once you see the world this way, you cannot unsee it. you realize that your bank account is not just a place to hold wealth, but a window into a massive, global, living organism. If you enjoyed this breakdown, share it with someone who is always asking why the economy feels so complicated. Subscribe to stay in the loop and keep an eye out for our next video where we will dive into how modern digital currencies might completely rewrite these rules. It is going to be a wild ride. Thanks for watching, and I will see you in the next one.